So it comes down to the hard part of putting a valuation on this company. What is up, YouTube? So I got asked to do a stock analysis on Cloudflare, ticker symbol NET, N-E-T. I don't really know much about the company. All I know is it has fallen from $221 all the way down to roughly $37, currently trading at $40 a share. Man, does this sound like a Cathie Wood stock or what? I don't even know if she owns this stock, but this just looks like one of those innovative stocks that have fallen off of a cliff. I actually want to compare it to Cathie Wood's ETF. So this black line is Cathie Wood's ARK ETF. I'm just going to throw NET right on top of it. Looks like a very similar chart. And wouldn't you know it, almost like identical twins. I took a quick look at Cloudflare's top line growth and it is phenomenal, but they are burning a ton of capital. So we're going to try to figure out what to do with this stock. Where can we get a price target on it? It's really hard as margins are all over the place. It's always hard to figure out what's a fair value for a stock that is hemorrhaging money, but we'll do our best in this episode. And by the way, if you're new to the channel, welcome in, consider subscribing and smash that thumbs up. Now, first, let's just start out with what Cloudflare is, as I'm not super familiar with it, so I'm just going to really run through the numbers, but I understand it being an IT defensive type stock here, where it deals with the DDoS mitigation. DDoS is denial of service attacks. So this is a type of company that protects other companies from getting a cyber attack, makes their networks run more efficient, more safe, and with more speed. So therefore, it has that defensiveness built into it. And it's definitely been a market where we could say is in high demand as of late, especially when we think about a lot of the cyber attacks that have been taking place and ransom that has been held for these cyber attacks that actually have been paid. So it's, do you pay millions of dollars for a possible cyber attack if you are, a Fortune 500 company, or do you take on a company like Cloudflare, install these systems and make sure that your systems run with speed and safety? So that's kind of the gist of what I understand it to be. I'm sure people in the comments could possibly enlighten me a little bit more on what they do. So right off the bat, we see here that Cloudflare has tremendous amounts of growth, both on revenue and large customers, growing at a 61% CAGR, which is compounded annual growth rate, and a 51% CAGR on the total revenue. So both growth rates on acquiring customers and on revenue, which obviously you need to see when you are in your growth phase as a company. So we can see here that they're pretty well diversified. They have 126 billion cyber threats that are blocked on a daily basis. That's pretty impressive. 156,000 total paying customers. So they're building a substantially large customer base here. And then their revenue is exceeding 50% with their larger customers, and roughly 47% of their revenue comes outside of the United States. So that's a nice little piece to see how their business model is broken up. We can see here that they have 47% year over year Q3 2022 revenue growth, 76% gross margins, which obviously with a lot of these software companies, you're going to get these higher gross margins. Now it's just coming down to actually getting the margins to the bottom line, and 1,900 large customers. So we can see here what large customer actually means, and that is $100,000 of annualized revenue, and they're pushing 1,900 customers in that realm. So huge growth in their large customer base, which is going to drive top line revenue growth. And if those margins can stay strong, should eventually come down to that bottom line growth, which we're going to go over is the problem with Cloudflare. So we can see here that the cash and cash equivalents have come down substantially. And with that, they do have an uptick in accounts receivable, which will be future revenue for the company here. So big hit here, and some, a decent amount of growth for accounts receivable, but nothing eye-popping personally. I'd be concerned about the balance sheet on this aspect here. So we can see here the convertible notes substantially high at 1.4 billion. Nice top line revenue growth from the 9 months ended and in the 3 months ended as well. coming through to those strong gross profit margins that they spoke about. So here's where it gets a little interesting. They're spending a ton of money on sales and marketing, on research and development, and general administration, which is leading to a wider loss from operation. Even though they are growing the gross profit, the loss from operation is widening. You don't like to see that. You want to see this going in the other direction, guys. So a couple things that's making their quarter a little bit stronger is interest on income and other income. When you bring it down to a bottom line, we can see here that that's actually what's causing the quarter to be a little bit better here. So while fundamentally the company is actually spending a lot more and is losing more from operations, it is making it up from interest income and from other income and expenses, which I'm not sure where that's coming from. We would have to dig in and figure out that one, but this seems to be a substantial amount, because if we compare that to last year, we can see here that they lost almost 84 million last year in total non-operating income and expenses, but they gained 4.7 million this year. And when we bring that down to a bottom line, net losses were 42.5 million versus 107 million. So here's what's interesting, guys. I would say that the top line fundamentals to me are still concerning, but they were able to somehow make the EPS look better because they are getting income from interest. And just to kind of close out here, we have generated significant operating losses from our operations as reflected in our accumulated deficit of 794 million as of September 30, 2022. Hey guys, so I want to just be upfront and honest here. They are diluting a decent amount of shares here every quarter, so we have to take that into consideration. So I'm going to use 6% share increase. So this stock is currently trading at an EV to EBITDA of, so this stock is currently trading at a forward EV to EBITDA of 100, while the peers trade around 12. Now, this is where it gets really hard to figure out a true valuation to be putting on a company, because they are growing rapidly. How long can they grow rapidly? Can they fix their margins? Can they slow down on their spending? And will that come through to free cash flow? So there's a lot of question marks here. They are obviously diluting. So there's a lot of things about this stock that I would say are red flags, guys. Boy, oh boy, is this a tough one. Forward PE on the stock is 348, guys. Okay, so this is definitely in bubble territory. Even though the stock has fallen from 200 down to 40, I just don't see the justification at these levels with the growth rates that they're having. Yes, they have phenomenal growth rates. You know, I project them to do a little over 30% over the next few years, still maintain double-digit growth. All right, so here's what I have for growth rates, guys. I have them doing 39% years 1 through 3. That gets them to 1.7, almost 1.8 billion in revenue by 2024. From there on, I have them doing 11% revenue growth and then 9% revenue growth. So they're basically going to do $975 million of revenue. Yes, I know that comes in short for 2022, but I'm using growth rates from years 1 through 3 of 39%. So I need you to look at year 2024 and say, is it realistic that they can double their revenue in the next 2 years? If the answer is yes, then these numbers are realistic. If the answer is no, then you probably don't want to use these numbers. A year 2030, I have them doing $3.1 billion in revenue. $624 million will be coming through on free cash flow. Okay. If we put a 30 times multiplier on that, we get a $17 price target for the stock. Guys, I'd be looking to buy this stock between $15 to $17 personally, okay? That's the price target that I would put on the stock. Now, with that being said, I think this is a tremendously high-risk, high-reward stock. It is nearly impossible to put a price target on it for a few reasons here. Number one, they are burning capital. Number two, they are diluting. Number three, they have massive growth that I don't know if it's sustainable. Number four, will they be able to get their gross profits to come through the bottom line in year 6 through 10? That's a huge question mark. So personally, guys, I think this is a very interesting stock. I think it's a very sticky business. Love the business. very hard to figure out what you should be paying as far as a premium, because the future of the company's free cash flow and the future of the growth rate seems to be pretty uncertain. Are taking on more debt, are diluting, and they are burning capital. So while yes, I think their business is very important, I do, however, believe that the fundamentals are very shaky. If you want to use a multiple of 50, you get a $29 to $30 price target. But personally, guys, I think that this is a very risky stock, and I would rather err on caution using a lower multiple on a company that really doesn't have any true fundamentals yet. So as always, guys, appreciate your time. Thank you so much for spending it with me, and we will see you next time, investors. Peace.